up ahead. Affirmative 612.
Welcome into the Wealthy Pilots Podcast. Ben George sitting in for Mark Killian this week as we are joined always by Scott Osborn. Scott, looking forward to talking to you about the ACE method today. I know we're going to get into this a little bit of detail, but just a little preview. Accounts, contributions, and elections, right? Why is this such an important thing to be considering for pilots?
Yeah, it's, when I think about the ACE method, specifically around, the contributions and how we're going to set up the accounts and ultimately the investments we're going to elect, there's just a simple framework to help somebody look at what they have going on with the money that they're saving and investing and make sure that they're giving it, really just a real quick glance and that good due diligence of, hey, do I have the right setup and do I have the right money going into the right places? And then ultimately, am I going to be, satisfied with where I'm putting that money long-term, when I'm 10, 15 years down the road, looking back saying, man, I'm glad I set that up versus, oh gosh, I wish I would have done X, Y, Z differently.
And I assume we're talking about this because, most pilots aren't taking the appropriate steps, right? I mean, I'm sure they're doing plenty in terms of investing, but are they getting the most out of what they're putting in?
Yeah. It's interesting because the pilot is getting a lot from the airline. When we look at like the major airlines, some of the legacy carriers or the legacy cargo carriers too, I mean, they're getting a lot automatically put in from their airline. And so, that's something that, we'll probably record a separate episode just on contribution strategy. But when we think about specifically for, somebody who's kind of getting set up, I think about a lot of maybe some of the newer guys, like when they're getting onboarded, they're taking in a lot of inputs about just being new to the company. And then they're getting their seniority built up. And, it can take some of those guys, I think, a few years to get settled. And the 401k is just going in the background. They know the company's, deploying some assets into that every single pay period. The non-elective contribution, it's automatic from the employer, whether you're contributing or not. And so they feel good that some money's going in there. But, when I think if you take a step back and say, okay, again, look at the ACE method, accounts, contributions, elections. So if we just start to break it down, the first one is accounts. We know that you're going to get a 401k. That's going to get set up for you. But is that the only account that you need? I mean, I meet many pilots that are, they've been on the job been flying for 10, 15 years and they have one account and that's the pre-tax 401k. It's not necessarily a bad thing, but it's definitely leads itself towards, I'll say, leaving some money on the table, leaving some returns on the table, leaving the opportunity to build some tax-free wealth on the table. And so if we can interact a little bit sooner in somebody's career and get them to kind of walk through this framework and first ask ourselves, again, some critical questions around this ACE method, accounts. What accounts do I need? I mean, and I would tell you everybody should have, ultimately, if you're married, you should have about 7 accounts. So if I'm married and my spouse is a stay-at-home spouse, these are the 7 accounts I want to land in, okay? First off, we're going to have the 401k. We also want to have the Roth 401k part of that, right? So if I'm at Delta, I'm logging into Fidelity, I'm going to at least see those 2 accounts. Inside of that, we're going to have typically a brokerage link for each one of those accounts. So I'm kind of counting those, even though when you log in, you see 4, that's really still kind of 2 sub accounts within the 401k. I got my pre-tax and I got my Roth. Reason we recommend getting into some Roth, and again, we'll get into this more detail in the contribution strategy, but the reason we recommend getting into some Roth is to kind of diversify some of those assets out of tax-deferred assets. Because again, the company, for most of the airlines, is only doing that NEC, that non-elective contribution, to the pre-tax bucket. And so if we want to take some of our employee contributions and maybe put those into Roth, that enables us to get some tax-free money there, after-tax money that's going to grow tax-free forever. And so we like that. But that's going to be, 2 accounts, the pre-tax and 401k and the Roth 401k. Next up, again, this is for a married couple. If I'm not married, I'm going to have 2 less accounts, but we're going to have an individual if you're single or a joint account if you're married. And that individual joint account is where we're going to put some after-tax money that's going to get pumped in every single month typically. And it's going to get invested very similar to the other accounts. It's taxed differently. We're going to pay some capital gains on that. We're going to pay a little bit of tax on the dividends in that account. But that's a really, really good way to start building some tax efficient wealth. And we typically recommend getting that set up as early as possible because we want to have a nice chunk of change there. That's the money we're typically going to spend first in retirement. And there's a lot of these pilots are not building that bucket as aggressively as they should be. And it's something that I always say, hey, when you're 65 and you start to live off your assets, you're going to want 7 figures over in that bucket. And if you're not actively saving there in that individual or joint account, it's something I think you're probably going to regret early in retirement. And there's a whole reason why we got episodes on that. But it really just has to do with tax efficiency in our retirement income. So the other 2 accounts we're going to then have for myself and my spouse are going to be an IRA and a Roth IRA. And most of our pilots know, hey, I make too much money to make a contribution to a Roth IRA or a traditional IRA. And this is where that backdoor Roth comes into account. And again, what we do, it's very simple. We make what we call a non-deductible contribution to that traditional IRA. We convert it over to Roth and we're flowing money into that. I'll get into that a little bit more here in contributions. But from an account setup standpoint, that's really where we should be. If it's just me, I should have 5. The individual taxable account, the 2 401k accounts, and then the 2 IRAs. And then if I get a spouse, I'm going to throw 2 more in there. So 5 to 7, depending on your situation. So that's kind of the account setup.
Okay. Yeah. I mean, I think that's probably a lot more than most people would anticipate. I mean, guessing 7 total accounts might seem like a lot on the surface. So kind of once you break those out, you get a little better understanding of how that's all separated out, especially in terms of tax buckets. But then what are we contributing to each? I know this is the C in this method, Scott. So what are we actually putting in each of these buckets?
Yeah. So after we have step 1 there in the A's with getting the account set up, we then want to look at, okay, what is the contribution strategy for each of these accounts? And again, this is a little bit unique based off of your airline, your age, your marital status, and ultimately even your cash flow, I would say somewhat matters here. But ultimately, you have this non-elective contribution. You don't get a choice. It's going to go to the pre-tax 401k. Now, I will say that, some of the airlines like Southwest recently switched where you can divert that NEC over to Roth, which I think is really interesting to consider. And a lot of folks should consider that. But we'll handle that separately. But most of them, that NEC contribution is going to go to the pre-tax 401k. Now, from a contribution standpoint, and this ties directly into elections, so you want to make sure that all 3 of these components, A, C, and E, we're intertwining into one plan here for your investments. But the contribution we want to direct to that self-directed brokerage account because we get access to significantly more investment options. I mean, you get, whether it's Schwab or Fidelity, you get access to all, 330,000 investment options that they have compared to the standard 6 mutual funds that are in the base 401k plan. And so we want to take a look and make sure that the contributions are going into that brokerage link account and we have a good, plan from an election standpoint. We'll talk about that in a second. And then we want to do an assessment to see if it makes sense for us to have those contributions going to Roth if I'm putting any of my employee contributions in. There's an argument to be made that I should do 0 contributions. Okay, it's kind of income related. It depends how much your employer is matching. Or not matching, but doing with their NEC. But we should do an assessment to see if I should do employee contributions or not. Okay. And then we have a third set of contribution, which is and this is in the 401k, which is the catch-up contribution for those that are 50 or older. The Secure Act recently made those have to go to Roth. And then also that's something that I have to do as the employee. So the NEC is not going to go towards the catch-up. So we recommend that you 50 and over, you definitely want to take care of that catch-up contribution, getting that set up right away in the beginning of the year. But then there should be an assessment based off of my income level and the employer NEC contribution, whether I'm going to contribute or not, and whether my contribution should go to pre-tax or whether my contribution should go to Roth. So we do need to do an assessment there. And again, we'll talk about that in a little bit more detail in a separate episode, but that's kind of the 401k contribution at a high level. What we want to be conscious of is if we get into too much money going to the 401k, it starts to spill over, market-based cash balance plan or retirement health account. And, those are notoriously, not performing very well from an investment standpoint. They're extremely conservative, and the investments in there the risk profile doesn't tend to match what the risk profile and risk tolerance is of the pilot or the time horizon. So we want to, do all we can to avoid money going into those plans, in my opinion, and divert those to, other accounts that we can contribute to, like these other 5 I mentioned. So next priority from a contribution standpoint is going to be those backdoor Roths for myself and my spouse every year. So for under 50, it's $7,500. Over 50 is $8,600 per spouse. So those are 2 contributions we want to do every year. Got until the tax deadline, so that just passed for this year. But we normally recommend just get it in January for the current year and get it. I mean, the longer that money is in the market, typically the better it's going to perform. So I'll try to get that money into the market and get it converted and get it moving. And then the last priority from a contribution standpoint is we want to get some sort of recurring monthly amount going into that individual or joint account. Now, I'll tell you, a ton of my guys might do a little bit less in that account in the beginning of the year, maybe $500 or $1,000 while they're working on getting this 401k maxed out, getting these backdoor Roths fully funded. And then especially when the 401k is maxed out, they're going to start getting a larger paycheck typically. And, again, you got to be conscious of this. It's airline specific. If there's a cash balance plan, it's not going to spill over to them. It's going to spill over to the cash balance plan. But we want to have a discussion and an intentional plan around that to make sure that we're maximizing the amount, coming home to us on the paycheck over the year too, to fund some of that taxable account. So that's ultimately where we're going to, like, the priority is of how we're going to contribute and fund. But, as our guys and gals get more senior, we tend to see that monthly taxable account contribution into that individual or joint account will grow from $500 to $1,000 to $2,000, and they kind of balance that with the pay raises they're getting to make sure that it's not all going to lifestyle, and that we're intentionally carving some of that pay raise out into funding, our tax-free future as well. So that's kind of on the contribution side of things.
Okay. Yeah. I mean, there's a lot that goes into it. All right. All this stuff adds up over time. So you got accounts, get inside of that, contributions, and a little more detailed here, the election. So once you have the money in, Scott, where should you be diverting that money to?
Yeah, good question. And I think on the election side, this is where it can get a little overwhelming. I think especially in the brokerage link or in the those self-directed accounts, or the IRAs or the taxable account, because each account has a different way that the IRS looks at it from a tax sensitivity standpoint. So a lot of times in that taxable account, I'll kind of start there for this discussion. When there's $0 in there, we're going to just get a couple low cost, low turnover, aggressive growth funds and try to get that account growing. But once we get a sizable amount in that account, typically 6 figures or more, we want to start really looking at how we can drive more strategic tax efficiency. Because again, we want to be conscious of the capital gains and the dividends in that account. So if I'm holding a lot of high dividend paying funds or stocks in that account, I'm going to put a lot of tax drag on that account because most of those are going to get taxed as ordinary income. There's a strategy we call tax loss harvesting that if we divest some of our investments and we diversify a little bit more in that taxable account, we can start to look at implementing some tax strategies in that account that can really, the data would say it adds about 2% of net performance efficiency to that taxable account because we're paying less in taxes through the management of the strategy in there. So, that's a little bit of financial lingo, but at the end of the day, all I'm saying is as we want low dividend, high growth elections over there. And then as the account gets larger, we should have some sort of strategic discussion around implementing other management strategies in that account, because it's only in those taxable accounts outside of the 401k, outside of the IRA, that we can really drive efficiencies around managing capital gains and managing dividends. That doesn't really matter in the 401k or the IRA because they're not, gains and dividends aren't taxed there. Okay. Now, coming over to the Roth bucket, Roth is typically where we want our most aggressive assets. We're going to spend those down the least amount. Typically, those are what we're leaving behind to our children in inheritance if we haven't spent them down in retirement, which most people don't intend to. And so we want those to be, 100% gas all the time as my general discussion that we're having around Roth IRAs, unless there's a specific reason not to, which is very rare. And so, we want to have a good aggressive allocation for those Roth IRAs. When we come over into the pre-tax 401k or the Roth 401k, it's kind of similar thing. You don't want to do a peanut butter spread, investment philosophy across all these accounts because they're all different. So even when I log in the 401k, especially if I'm getting in that brokerage link, okay, now I can buy whatever Fidelity has, in their entire investment universe. Same thing in that pre-tax Roth 401k. We typically want to be hyper aggressive there. Obviously it's got that investment profile needs to match the investor's tolerance for risk. But, through good planning discussion, you start to say, hey, we're not going to touch this money for 20, 30 years sometimes. It gets easy to say, okay, we can be aggressive here. And then that pre-tax 401k is typically, of all these, 5 to 7 accounts, that pre-tax 401k is typically the largest account, just because there's so much getting contributed there from the airline, that is the one that we really need to have a really good anchored discussion around, and making sure that account is matching the investor's risk profile, and that it's not getting too aggressive for, when they're going to need the money in retirement. Make sure it's not getting too aggressive that you're putting the investor in a situation where they see too much volatility that they can't handle it. I don't run into that too much. But that's something that the investor needs to make sure they're really intentional with. And then ultimately building out the portfolio where, again, we're buying investments that make sense for this investor, that are in their best interest, that are low cost, low turnover, have good market exposure to different markets, and ultimately are delivering on the investor's goals. I mean, some folks want to seek out some, tactical management with downside risk protection. Those portfolios are out there. Some are a buy, hold, and rebalance, and we want to just, drive that philosophy into the portfolio, and, having the ability to build that out is super beneficial. And you can do that inside of the brokerage link a lot more effectively than you can in the default options. So, but yeah, investment election is, typically going to be the most important part of this whole thing when it turns out to what is the final number that I'm going to have when I retire. The accounts and the contributions, make a difference absolutely in terms of the final tax disposition of these dollars. But in terms of the gross amount that we're going to get from investment performance, this election piece is vitally important. So again, way too much there to really unpack here in a short episode. But at the end of the day, it's more so having a framework here to say, hey, have I looked at the accounts? Do I have the right ones? Have I looked at the contributions and the ones I can control? They're going to the right area. And then do I have a process by which I elect these investments and stick with them and manage them over time?
This approach and this framework is so beneficial for pilots. And you might be saving money, but are you doing it effectively and intentionally? In today's episode, hopefully we'll kind of walk you through how that process looks as you work with Scott and the team there, Patriot Wealth Planners. But really good information. Scott, I know we'll get a little more detail on contributions and some mistakes pilots make with their 401k in future episodes. So I encourage you to subscribe to the channel if you haven't done that already. Appreciate that support as well. And leave a comment if you have some thoughts on what Scott's talked about today. All right, Scott, as always, appreciate your insight into this. We'll look forward to talking to you again soon.
All right, see y'all later.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.